Hi, welcome to this video today, which is all about risk to reward ratios in Forex trading. How to calculate the risk to reward of a trade, how to pick the best risk to reward ratio in terms of your strategy, and how to avoid fatal errors that most beginners make. And there's a good number of errors that traders make in relation to the risk to reward on their trades, which makes them lose money. They confuse, for example, probability of a trade with the risk to reward. They see the risk to reward as static when it isn't, and there's a good few others which I want to go through on a storyboard. So let's go to the storyboard and take a look at all these points in more detail. Right, let's have a look at Forex risk to reward ratios in a little bit more detail. We'll start with point number one, which is how do you calculate them? It's extremely easy. All you do is you take the amount you're prepared to risk on the trade, i.e. to your stop loss, and compare it with the amount of profit you've chosen as an objective. Okay, so if you're risking $100, your profit objective is $200. You're risking half of what you want to make, so the risk to reward ratio is 2 to 1. Okay, you're going to gain double what you're going to lose on the trade as you see it. Okay, so it's extremely easy to calculate. If your profit target was $300, what's your risk to reward ratio? Of course, it's 3 to 1. Now let's look at point number two, risk to reward ratios and the win rate needed for you to make an overall profit on your trading account over the longer term. A risk to reward ratio 1 to 1, you risk 100 to make 100, you need a win rate of plus 50%, okay? And the ratio will decline as the risk to reward ratio increases. So for example, on 2 to 1 risk to reward ratio, just need to win 33% of your trades. 3 to 1 it's 25, 4 to 1 it's just 20%. Okay, of your trades need to go right for an overall profit. Now, what is the best risk to reward ratio? I'll just come back to that in a moment, but what I want to do is cover the next point, which is very important first, which is a common problem from most beginners. What they do is they confuse money odds with probability odds. The risk to reward ratio you choose for your trades is not the probability of the trade coming right. It's a subjective judgment made by you in relation to your strategy. And you've always got to keep that in mind. If you've researched a strategy with an edge, you'll come up with risk to reward ratios. But they must be based on sound research, and you must always remember it is your subjective judgment, not the probability of the trade. Now, this does cause a lot of problems for traders, which I'll again come back to in a moment. Just want to go through best risk to reward ratios to choose in terms of your trading strategy. My own view is if you're a technical trader, you're a beginner, I would say 2 to 1 to 3 to 1 would be good risk to reward ratios to research in relation to a strategy. You don't want to go higher than that. Why? Because technical trading, it's very difficult to get the bigger risk to reward ratios or make a judgment that you could make, say 4 to 1, 5 to 1. I know traders will go 10 to 1 without knowing what's going on behind the chart. So if you're a sentiment trader, or trade the fundamentals and look at them behind the chart, you can make those judgments. You can't purely from technical. So technical traders do 2 or 3 to 1. In terms of if you're doing fundamentals and sentiment, bigger risk to reward ratios. Either way, there's no best way as such. Both, or any risk to reward ratio that's sensible can make you money. Okay. In terms of, keep in mind the risk to reward ratio changes. It does. A lot of traders think it's static. They put on the trade, they leave it. They either hit their objective in terms of profit or they hit their stop loss. They don't understand that the risk to reward ratio is changing all the time. So let me give you a couple of examples. Let's say you've got a breakout trading strategy. You're expecting a strong breakout of a level and for it to follow through strongly. The breakout occurs, then the price comes back and stalls. Well, if your strategy says that breakout should continue, the risk to reward ratio should change because it's not doing what you think in terms of price action. So very often it's best to say, okay, this trade is not working out. I'm not going to wait for my stop loss to get hit. Yeah, I think my chance of my target being hit are reduced. I'll just take the trade out. So it could be a small profit, it could be a small loss. It doesn't matter. Get out the trade. There's no point in hanging on to a trade if it's not doing what you think and keeping the existing or the initial risk reward ratio in place. The same goes for, let's say a trade really runs in your favor. You get a really strong breakout. It's even stronger than you expect. Prices are really going strongly in one direction or another. Your initial risk reward may have been 3 to 1. You might want to change that to 5 to 1 or whatever it might be. So keep in mind it always changes. Now, in terms of bigger risk reward ratios, they're hard for most traders, okay, particularly beginners, because if you're going 4 to 1, 5 to 1, 10 to 1, then basically you've got to hold that trade through inevitable retracements and not be tempted to snatch it. Most beginners in particular, they don't want to lose money. As soon as they get a bit of profit, they're excited. Then it comes back a little bit on them. They don't want to see that trade turn into a loss. They've got a small profit, they'll snatch it. Okay, so I think a bit of experience, in terms of going for the bigger risk to reward ratios. Now, in terms of the fatal 1-to-1 snatching trades gambling error, it's amazing actually how many beginners actually end up with a risk to reward ratio of 1 to 1 or even less. Just mentioned, snatching profits too early. Okay, you won't get anywhere unless you run your profits to cover your losses. But many traders actually end up with trades that are even less than 1 to 1 because they get in the trade, okay, and have initial profit objective. Let's say it's twice their risk, and then they decide when they're starting to lose to move their stop loss back or not have a stop loss at all. So they're risking way more than they can make because they don't want to take the loss. You've got to be aware of that as well. It's such a common error. Okay, we know that running losses, snatching profits is a way to lose in Forex trading. Is guaranteed to make you lose. But so many traders do it. So in terms of risk to reward ratios, I think key point to keep in mind is really research your strategy so you can make a subjective judgment that your risk to reward is a good one. Always keep in mind that any trade can go wrong. That's why money management is so important. Manage your trades. And basically when you're starting, like I said, have those smaller risk to reward ratios. You can make money on them, doesn't matter. The bigger risk to reward ratios suit more experienced traders. And like I said, probably the traders who have a knowledge of sentiment and fundamentals behind the chart. So that is the video for today. I hope you found it useful. Thank you very much for watching me as usual. Take care. Have a good day.